Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing from Biomea Fusion, and let me tell you, this one's got more twists than a pretzel. We're talking about stock offerings, warrants, and financial maneuvering that could either send this company soaring or leave it grounded. Before we start decoding, if you are a fellow number cruncher who find the insights invaluable, do not forget to subscribe. Also, feel free to join to our Discord channel to discuss more. The link is in the description below. So what's the big picture? Biomea Fusion, a company you might not have heard of yet, just made a deal involving a lot of shares and something called warrants. Basically, they're selling stock and offering these warrants that give people the right to buy more stock later on. The details matter because they can tell us about Biomea's financial strategy and how they plan to grow, or maybe just survive. To make all this happen, Biomea brought in Jefferies LLC, acting as the representative for a bunch of underwriters. These are the folks who help sell the shares to investors. It's like hiring a real estate agent to sell your house, but instead of a house, it's company stock. Okay, let's get to the numbers. Biomea is offering over 19 million shares of their common stock. They're also throwing in something called pre-funded warrants, which could add another 550,000 shares into the mix. And if that wasn't enough, they're adding even more warrants to purchase a whopping 20 million shares. All these shares and warrants are offered in a combined format for a combined price. One has a $20 combined price and the other a 1.9 price. One has a $20 combined price and the other a 1.94 for combined price. One has a $20 combined price and the other a 1.99 price. It's a lot to keep track of, but the bottom line is Biomea is trying to raise a significant amount of money. Here's a kicker: the underwriters have the option to buy even more shares and warrants within 30 days. We are talking 3 million addition shares. If they use this option, it means even more cash for Biomea, but it also means potentially diluting the value of existing shares, that is making each worth a little less. Now let's talk about these warrants. The pre-funded warrants have a super low exercise price of just 0.000 on 1 per share. That's practically giving them away. The other warrants, called common stock warrants, have a slightly higher exercise price of $2.55 share. But there's a catch with these warrants, and it's called the maximum percentage per share. This maximum percentage basically means that no single investor can use these warrants to own too much of the company, which would be bigger than 19.99%. It's a way to prevent someone from taking over Biomea without the company's consent. The common stock warrants also have special protections in case of a fundamental transaction. This is a fancy way of saying if Biomea gets bought out or merges with another company, the warrant holders get something of value. Basically, they get paid out based on a formula so they don't get left out in the cold. So after all the selling and dealing, Biomea estimates they'll pocket around $37.27 if we take into account all commission fees and expenses. If those underwriters use their option to buy more shares, that number could jump to over $42 million. That's a lot of money. All these shares and warrants are being issued under a previously filed shelf registration statement that simply means that Biomea had already told the SEC that they might offer these kinds of securities, which is more of a head up than anything. The legal agreement, the amended underwriting agreement, is full of standard stuff, promises, guarantees, and who pays if something goes wrong, like if the company misrepresented its financials to the investors. It's all the fine print that makes the lawyers happy. Now let's sum things up. Biomea is raising a nice chunk of change through this offering, and the money will help them fund whatever projects they have coming up. Now, there are definitely things to keep an eye on. Too many shares in the market could drag down the stock price. Those warrants could add more shares later, which dilutes the value of existing shares. And that maximum percentage clause, it's a way to protect the company from a hostile takeover. From the numbers, my assessment of Biomea is that they are moving forward with a strategy that could pay off big time if their plans work out. A potential risk is that they might become very dependable and have a hard time operating independently. Alright, that's our breakdown of Biomea Fusion's recent financial moves. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.